So your first fears versus facts about buying a home. Your first fear, I can't afford to buy a home right now. The fact is, until you do the math, you don't know what you can or can't afford. So we have Linda here, he'll be able
Yeah,
to
she'll be able to
give you
talk.
ideas about that.
Because we believe in staying in our lane.
All right.
The next fear is I don't have the money for the down payment. And the fact is there are a variety of down payment options and programs available to you. You know, I'm very surprised that a lot of people don't know, like, you can use your 401k, you can get a gift from family members. And of course that does come with some additional steps that Reggie will cover. And then there's also down payment assistance program. Like Reggie has one called Cardinal Lease. There's Georgia Dream and various programs available to you.
Fear number 3, I should wait until the market gets better. This is a very popular one. There is never a bad time to buy your first home.
Never.
Never a bad time.
Never ever.
Never.
Because I know you guys probably here have heard a lot about the market, it's not a good time to buy. That is so not true. As long as homes are appreciating, it is always a good time to buy. Always. I can't afford to buy my dream home is another fear. People want to, when they're looking at buying their first home, they think they need to wait until they get to home with the pool, with the this, with the that. But the fact is, the best way to get closer to buying your dream home is to buy your first home. Because with that first home, you'll have equity and appreciation that will get you in your forever home. So for example, if you bought, like I had a client who bought a townhome for $118,000. She stayed in it for 10 years, she had $100,000 in equity. She used that equity to buy a bigger home and to keep her payments where she wanted it to be. So she stayed in that first home, but that $100,000 over 10 years put her in a position to be able to buy the home of her dreams. So that's how you have to think about it. Your first home may not be everything, but it will be a smart investment property for sure. Because you gotta pay rent to somebody, right? So why not pay yourself?
Some reasons to hold off on buying. If you're changing jobs, if you don't have job security, you're at a new company, if your credit score isn't where it should be, and you just don't have any options for a down payment. Too expensive house port. So when we say house port, you don't want to get into a house and all you can do is pay your mortgage. You don't have no money for anything else. So those are some reasons to hold off. Uncertainty, decision paralysis, and what ifs. Those are some things that keep people still and make them not make a move. But working with the professionals, we can get you past the decision paralysis and the what ifs.
Yeah.
We can speak to those things.
Absolutely. So next we'll discuss the realities of the real estate market in Atlanta. I know a lot of people have heard various things, but we want to be able to kind of point out some of the facts. And so, number one, inventory is still tight, believe it or not. It is improving slightly, but Atlanta remains a low to moderate inventory market, especially for homes under 500,000. New construction is helping to bridge that gap when it comes to the lack of inventory that we have, but not enough to fully balance supply. Do you guys know why inventory is so tight? Like, has anybody ever explained to you what caused this huge gap and why, like, around COVID, everybody went crazy with houses? Do you understand why the inventory is tight? And I'm gonna share something with you probably hadn't considered. When the market crashed in 2008, builders packed up and stopped building for what, Reggie, about 5-6 years?
Yes.
So we are still behind like 2 million homes for those years that they stopped building. And so because of that, inventory is what it is. However, not to discourage you because there's still great opportunity, but just know that inventory is still tight. And sometimes when you're looking to make a move, you don't want to spend too much time thinking about it. And then entry-level buyers still face competition in desirable areas. So nice homes don't sit long. when the right one hits, you need to be ready to pull the trigger.
Prices are stabilizing, but not crashing. Appreciation has slowed compared to 2020 and 2022, but values are holding. Many areas are seeing modest year-over-year growth, not declines. So that's why it really is a good time to look at home ownership. Atlanta remains a net in-migration city, which supports pricing. Waiting for a crash has not paid off in this market. We're not crashing.
Absolutely, because everybody keeps saying, I'm waiting for the market crash.
Yeah, it's not no problem.
Don't think it's gonna happen, because what we're experiencing right now, to her point, prices stabilizing, is because during COVID, everybody knows supply and demand, just like with COVID. There was, Lysol was $2, and then 3 weeks later it was $25. So it's all about, right now, what we're doing is, because of what happened during COVID, everybody was wanting to buy a house because interest rates were so low. Now what you're seeing, prices aren't, they're dropping, but they're stabilizing because it was kind of an artificial appreciation because of the demand, or lack of demand. Interest rates that you see are the new normal. Rates are higher than the pandemic lows, but buyers are adapting. Most experts expect rates to fluctuate, not drop dramatically short term. Buyers are using strategies like seller concessions, rate buy downs, and adjustable rate loans. And Reggie will go more into rate buy downs and adjustable rate loans. But what we are seeing in this market, even though sellers were resisting a little bit, but what we are seeing more now is sellers are paying concessions to help you with those closing costs, with you to be able to buy down your rate. Because at the end of the day, if a buyer can't afford, like if it's over whatever they want to pay, they're just simply not going to do it. So you do find motivated sellers doing that. I have one right now. This house is $265,000, and I was able to negotiate $15,000 in repairs, and $15,000 in seller concessions, and now her interest rate is a 4.99. So choosing the right agent is definitely something that you want to do. You want to have somebody who knows the market and who also knows how to negotiate. And the goal isn't always about chasing the lowest rate. It's making sure the payment works comfortably for you today. That's what the goal is.
Monthly payments matter more than price. So yes, so like Charlette is saying, you want to work on what price you want to pay, not necessarily the price of the home. Right? Affordability is now driven more by rate and insurance and taxes than just purchase price. Rising insurance costs, especially in parts of Georgia, we've really gone up here, are impacting budgets. Buyers are adjusting expectations on size, location, and condition. Buyers shop based on payment comfort, not max price. So like if you, again, Reggie will speak more to this, but if you get approved for $400,000, you don't necessarily want to go to the full $400,000. You want to see what house you can find with a payment that you're comfortable paying.
And as Keno just told you guys, new construction is a major player in this market. Builders are aggressively competing with rate buy downs, closing cost incentives, their warranty coverage, free upgrades. And this is often where buyers find the best deals in today's market. Many resale sellers cannot compete with the builder incentives. But I will say, with the right agents, sellers are understanding that they have to compete with new construction.
With the builders, yes.
Yes.
It's a split market, not one market. So entry-level homes, still competitive under $400,000. Mid-range homes are more balanced at $400,000 to $750,000. Luxury homes, they stay on the market longer at $750,000 to $1 million and above. Most first-time home buyers are shopping in the most competitive segment of the market, which is the entry-level homes.
And the days on markets has increased, but homes in good condition still move fast. Compared to the 2021 frenzy, Homes are just sitting longer. And to be honest with you, it's a normal. Like, homes selling in 2 hours, that's not a normal market. Homes having 150 offers in one day, that is not a normal market. So now, homes are sitting longer, so it doesn't mean that there's necessarily something wrong with it. It's just now the market is balancing out. Homes are sitting longer. But when they're well-priced, move-in ready homes, they will move quickly. So the market is more rational, not slow.
First time buyers need strategy more than ever. Because again, we're in that entry-level price point and the competition is heavy. Financing strategy is critical. Timing matters less than preparation. Guidance equals competitive advantage. In today's market, the agent you choose matters more than ever. Because your agent is gonna help you be prepared so that when you find something that you fall in love with, you're ready to move.
So next we'll go to the 10 easy steps to home ownership. Number 1, decide to buy. Number 2, find your agent. Number 3, secure financing, and that's when we'll have Reggie come up during that segment. Number 4, identify your criteria. Number 5, find your home. 6, make an offer. 7, perform due diligence. 8, close. Number 9, move in and protect your investment. And number 10, enjoy service for a lifetime.
Step 1, decide to buy. Home ownership lays the foundation for a life of financial security and personal choice. So it's an investment. And when you have investments, you have choices in life later on.
Sure. Step 2. Go ahead.
Find your agent.
So your picture's there.
As your agent, we educate you about the market. Analyze your wants and needs, find homes that fit your criteria, negotiate on your behalf, and solve any problems that may arise. Because of our expertise, if a problem does arise, we've probably seen it before. And if we haven't, we're in an office with 300 agents. Somebody has seen it. We can help.
Absolutely. And also, too, I want to go a little deeper on analyze your wants and needs. You know, everybody, obviously, when you want to buy a home, like, we always have these boxes that we want to check off. And so when we meet with our clients initially, we ask them, like, what are the important things? And then when you tell us what your budget is, we have to find things that fit your criteria, and your budget is part of your criteria. So if you say, hey, I don't want a payment over $2,200, then you're gonna probably be somewhere around $265. So you may not get the big yard, you may not get the marble bear claw tub, you know what I mean? So our job is to hear what you want and be able to share with you based on your wants and needs, hey, this is what we can do, and this is what you can get based on the criteria that you provided. So it's really good to sit down with your agent and have a conversation about what it is that you're looking for, and also your agent will be able to share with you what's going on in the market and show you homes based on what your payments would be. And the buyer's representation agreement. This is an agreement between you and us as your agents. It sets a mutual expectation in writing, and a lot of people don't know this. In Georgia, it is a law. In order for us to represent you and have a client relationship, we must first enter into a written agreement. And this also commits me to finding the perfect home for you. And last but not least, this confirms exclusivity between both of us. We are in a marriage in a sense. and you know what? And guess what? There's always opportunities where, you know, you may become frustrated, and just know that your agents are working on your behalf. And we haven't met a buyer that isn't going to become frustrated because it's new territory for you. But understand that your agents are committed to getting you into your home and making sure that you have a sound investment. That's our number one commitment. And let's introduce Reggie Graham with Cardinal Mortgage.
Hello. So a little bit about myself. I've been doing this for 30 years. I work for home builders. I work for independent brokers. I've been an independent broker. Right now with Cardinal Financial, the reason why I like Cardinal Financial is because we kind of, and everybody hears about AI and all the automation, we put the best of like actual people, with the AI, so speed up your process, to make sure everything stays compliant and everything, and that is a big deal in the market that people don't realize. So when you go through it, like they said, there's gonna be some frustration. Part of the frustration will be paperwork, which we'll kind of go over some of that stuff. So,
What are you hitting?
Just hit, I'll do it, 'cause I don't want to. Sorry, y'all, we got here today and we realized that we had to adjust to what we rehearsed.
And the thing that a lot of people don't realize is that the pre-approval process is the biggest thing. This is what saves you the headache. And you really gotta know what a pre-approval is. A pre-qualification is not a pre-approval. So a pre-qualification, is you telling me I make $5,000 a month. This is my, this is how much I make. I get this additional income. My husband makes this amount of money. But and then me saying, okay, based on, and this is my credit score. And that's based on, and then I say, oh, you can go for $400,000 or $350,000. And then you go shop on that. A good agent or realtor is not going to take you out on that, because pre-qualification is based on what you stated. You may know your finances down to the nickel, but we look at it differently. So a lot of times, just in the event, like people will put in, someone will say, I make $60,000 a year. Then I'll get their application and they have $3,500 a month, because they're putting net what they're bringing home. We go off your gross income. So those are different things. So with that pre-approval also comes us, we review your credit. We review any issues that we may see come up. Like a lot of people, like everybody's into fixing their own credit. So you may my credit score is a 680 on all my bureaus, but I look at your credit report and I see that you have disputed items on your credit. People don't know that you can't close your loan with disputed items and qualify for certain programs. If the disputes are over $1,000. So if you go in, you're like, okay, I ain't never paying them, but I saw them disputing it. You may be better off just like letting the dispute fall off, and then just closing on that loan. Those are things that your loan originator will actually help you with and help you make those decisions. Also with the home search, I may tell you can afford $450,000, and then you're like, oh, that's great. We start looking at $450,000. But what I tell a lot of people, they go, oh, you don't have to go to that max. That's what Monica came in talking about house core, because when you got a $450,000 home, you got a $450,000 home water bill, electric bill, taxes, and those things too. So, and then you're probably going to have an HOA, because it's probably going to be a nice, a pretty nice home, unless you're just out on some land. So when your home search comes, as a lender, we give you the max. So if I say you can afford $450,000, it's up to you, and I show you that payment. It's up to you to actually consider what you can afford. Like she said, she had a client say, I don't want to go above $2,200 a month, no matter what. Then you look at that and you talk to your agent. It's like, hey, Reggie's approved me for $450,000, but I don't want to go above. We've talked about it, and we want to try to start looking at $350,000 to see if it's something we can find. Because you're leaving yourself some room, because sooner or later you're going to buy a new car, or you got something's going to break down, and you have these things. So our job is to tell you what to do. Some families go in and say, hey, only I'm going to be on there. My wife's not going to be on there, or vice versa. Or we have someone else moving in with us. They're taking care of a relative. So I work you through all those things, because the people are like, hey, I'm taking care of my dad. He's going to live with us, and we need more room. Can we add it to the application? Those are different things that you go through in the pre-approval process. So when you go out with these ladies and you look for a home, then you're ready. You're ready to go, and you know what your numbers look like. The application, part of the application is getting in your paperwork. I like to get it all up front and get your file underwritten. So usually that's going to look at, if you're looking at a regular FHA, VA, or conventional loan, your last 2 years W-2s. If you're doing certain programs, your last 2 years tax returns. I'm still going to ask for the tax returns, even though you may not need them, because I don't want anything popping up and biting us in the butt later. Because if you switch to a program and you say, hey, I'm doing our Cardinal Elite program that doesn't require tax returns, and then you say, okay, we got this Atlanta housing program, and they want to see your tax returns, you may have wrote off a business that may be defunct or not, but you wrote off $20,000 worth of your income, and now you don't qualify because they take that business loss against your, against your job income. Those are the most things that we run into. Or also people have child support, or they have liens. Like we may not put it on the application because you're not a professional, I am, but when you get your paperwork, I see, oh, you have these deductions from your pay stub, you know, so that reduces your income. Those are things you want to look at. Rate lock, this is real sensitive right now because this market with the, what is it called? The excursion we got over there in the Middle East, the rates change every week. You know what I'm saying? The rates change every week. So the thing about it is you want to get pre-approved on a rate. You want to get pre-approved on a rate. You can't really lock in a rate until you actually have a property. So the thing about it is like, I don't want to say, oh, this rate is going to be, no one should pre-qualify you on a buy down. So you're talking about a buy down. A buy down is like, oh, well, we can buy your rate down to 4.99, you know, or 3.99. You should get, because people don't realize you still qualify on the fully amortized rate. So what buy downs are is like, they say you're going to end at 3.99. But like in this case, a builder or a seller would pay your closing costs to buy down your rate. You would start off at 1.99.
So I do have a question, because a lot of people get confused. Only the sellers can pay for your buy down.
Yeah,
right?
only a seller can pay for your buy down.
Okay.
So in a buy down, it has to be a seller involved to do a buy down. So you can do a step up, you can do a step loan or a step arm, like where you start off yourself at like 3.5, then it goes to 4.5, but you're paying those closing costs. But a true buy down, only the seller can pay, pay those funds. They can't come out of your pocket. So when you do get approved for a home and you do find that home, the biggest thing is you want to get your rate locked in. Again, like I said, the rates could change. We could wake up, CNN and Fox News say, oh, we bombed, whatever, this guy happened. And then the rates people think the rates come out that morning, they stay the same. The rates change all throughout the day for each program, for each lender. So it's important, like I sit in my computer and I'm like, okay, Mr. and Mrs. Smith, y'all pre-qualified, hey, y'all got this property, do y'all like it, do y'all want to buy it, do y'all get an inspection? Let's go ahead and lock in the rate. Locking in the rate does not mean that's the rate that you're stuck at. You can say, hey, we want to get a lower rate. It's going to be based on the day we locked it, but you can say, I'll pay another $3,000 to get another quarter of a point. But the thing is, as a lender, we want to show you how much that costs. Because if it costs you $5,000 to get down to another half a point, but it's only going to change your payment by $30, $30 a month, you may want to keep your $5,000 in your pocket. You know what I'm saying? It's like, especially because overtime, like, okay, I'll take that overtime day and take it, to save that money. So, processing, basically after your loan is approved, you guys, we call them transaction coordinators, but you have processors. As loan originators and loan officers, we come up with a plan. So we tell you, hey, this is the loan that these are the best loans that you qualify for. I'm going to show you, like, here's your no down payment, here's your down payment, here's a conventional loan, here's an FHA loan. You pick which one you can work with. So somebody should be able to show you side by side or whatever your different options so you can pick. Because just telling someone a rate, like they said earlier, doesn't mean anything, because that loan could have a lot more closing costs, or it's not as flexible as far as the underwriting and everything. So it's not just on that. So when we go through processing, we send it there and then we send it to underwriting, and that's where we find out any particular issues that you might have as a buyer on your loan. It may be something like, hey, I had a bankruptcy, and they're like, okay, you gotta wait, you can't close until this date. It doesn't mean that you're not approved, but you have seasoning on things like bankruptcies, foreclosures, and short sales. That's why people can't, like, if someone said, I wanna move in June or July, they should already have been getting pre-qualified so they could get all that stuff out the way and they know what's going on. Or you need assets or you need reserves. You may need to save up money, for the 2 or 3 months reserves. Reserves are just like you move in and then your payment's $2,000 a month. They may want to see that you have $4,000 in an account somewhere after closing, after all your funds are being closing, to make sure you can pay your mortgage in case you got sick or you missed your job. The most often payment that people miss is the first payment. Because they saved up all the money, to get into the house. They had to pay the move, they got some furniture, they're like, oh, I missed that first payment. So that's what's called first payment default. They're not gonna, they're not gonna foreclose on you with that, but that's what lenders, that's what lenders look at. So that's why a lot of times they want people to have reserves, whether it's in a 401k account, CDs, or something like that. And then you gotta make sure that's an asset. Like teachers, sometimes you can't use their TRS as an asset because they can't get it until they retire. Some union workers, I have a union client, he has like 20-some thousand in there. I have my reserves, and I look at the terms of withdrawal, and he can't use it unless he's 59 and a half, or and he's retired. So those are all assets aren't equal. And then you get the closing. Closing is basically, you've already, so once we get you pre-approved, that's they've ordered that appraisal, the title. These ladies are gonna talk about, you know, home inspections. We don't necessarily need a home inspection. So how I describe home inspections are, home inspections help you sleep better, the appraisal helps the bank sleep better. Because we wanna make sure it's worth that. We don't care about it's ugly or, or nothing like that. We care about the safety of it and the bones of the house. If it's gonna need a new roof, we got mold in there or anything that's gonna affect the value, that's what we care about. And then at closing, that's another part too. A lot of times people are like, okay, I got pre-approved, and they wanna know like, oh, I need $5,000 to close, or I need $500 to close. When do I have to have that money? You need to have that money. If you're closing on Friday, the latest somebody needs to see that money in your account is most likely Tuesday morning, because it has to go back to underwriting. They have to prove and make sure it's an acceptable amount. Like people go get, oh, I got money at home. Literally, I have people like, I got money at home in a bag or in a box. You cannot use that money. It's your money, but you cannot use that money. Everything has to be sourced or whatever. So you can use it to go pay your electric bill, your gas bill, your car bill, but you cannot use that to bring your money to closing. And I do run into people like that. They're like, I have $40,000, I had a client last year, I have $40,000 at home in a safe. And so I got the money, but I got bank statements, there was barely any money in them. Like, you need to go deposit the money, let it sit in that account for 3 months, or whatever. I don't trust myself. Well, then don't get a debit card. Don't get whatever on that account. So, when Monica was talking about earlier about your payment. So your payment consists of your principal, which is just the loan amount and the interest rate. That's your PI, and the TI, your tax and insurance. So your tax is affected. You might a $200,000 home over here and a $200,000 home in Alpharetta. They're not going to be the same thing because the taxes are going to be different. So that's something you got to look at. Even also when you go in and you look at homeowners association dues. If you go look at a condo that's $250,000 and a home that's $250,000, that condo probably has at least $150 a month association fee, where your home has maybe a $25 a month association fee. So you wouldn't be able to afford that condo, believe it or not, even though you can afford that home, because that homeowners association fee affects your debt to income ratio. So that's what you also gotta let me know as a lender. Like, that's why I asked earlier, like, are you looking at homes? Are you looking at townhomes? Are you looking at condos? Things like that. Your taxes again, and the insurance, homeowners insurance. Right now, like there's tornadoes yesterday in Oklahoma. There's floods and stuff like that. So insurance costs have gone up. So what I do with a lot of clients, and they're like, oh, I can get insurance. I'll just go with my people that I got my car note with. You really want to shop your insurance. This could make or break your loan, the cost of your insurance. So that could be a difference of $30 or $40 a month and change your approval amount. Because some people are like, oh, I'm with this company, and they bundle it. What people don't realize, when they bundle insurance, they're putting most of your car insurance is so cheap because they're making your home insurance more. But also, it's harder to change your homeowner's insurance because it's escrowed in your payment. So for you, literally, if you close on the house and you want to go change your insurance, like 2 years later, you have to pay for that whole insurance premium up front. So you can't just do like your car insurance, be like, I stopped paying them and I start paying a new company this month. So that's one of the differences. Then you have closing costs. This is where your agent is very important. I tell people, you have to get an agent that understands understands what you're looking at and understands your plan. I love it when an agent calls me, they're like, hey Reggie, my client got a pre-approval letter for you. What type of loan are they doing? What kind of money they need? Not like, are they doing an FHA or conventional loan? Because that doesn't tell you everything, So closing costs are 3 to 5% of the purchase price. So if you look at a $300,000 home, you're looking at minimum $15,000 in closing costs. The good thing about it is the seller, on an FHA loan, the seller can pay up to 6% of the purchase price towards your closing costs. So they can pay all your closing costs. On a conventional loan, unless you put down more than 10%, then the seller can only pay 3%. So conventional loans are a lot more stringent for a number of reasons, as far as the credit and the DTI. And what these include are lender fees. Our fees aren't really that much. Like, the lender fees aren't really most of it, but you have title, just like you have a car, and taxes. So like, you get a car, you have tax, title, and license, you have all those things. So you have to pay fees to the state of Georgia. People don't realize every time you close a loan, and the bank has to pay fees. If you're in a certain area, the water fees. If you're in the city of Atlanta, you know what I'm saying, they make you put a deposit in your closing when you buy that property to put with, you know, with the water company and things like that.
And HOA.
Oh yes, your HOA. So if your HOA is $1,200 a year, you probably have to pay an additional $600 at closing, so you have a balance, you know, in your HOA, just like you do with your taxes. So when you talk about the closing costs, you have that escrow. What we mean escrow is that your taxes and your insurance are all in your mortgage payment. So if you just pay your mortgage payment, you're done that month, unless you have an HOA that's separate, is that you have to set up an account. Usually they're gonna collect 3 to 6 months, depending on the time of year you close, of your taxes, 1 whole year of insurance, so that you're never behind in insurance. It protects you, but also protects the bank. The bank doesn't want you out there, no smoke detectors, kids out there doing, you know, marshmallows or doing something and burning up the house and have no insurance. It protects them too. And then the title fees. So that's really, they pull title. Sometimes you have to have a survey if you're in a house that hadn't been surveyed for a while. I had a borrower he's doing in Florida. He's buying a manufactured home. It's a $400,000 manufactured home. The guy has built like a compound. So I didn't think it was gonna, but he's never had it surveyed since he put these extra buildings and attachments on there. That survey costs $1,500. So those are things your agent would also help you too, because he or she would say, hey, you have a recent survey on here. Have you had a recent termite inspection? Or do you have a termite bond? Those are things that you wanna look at too, because if the seller's already doing that, then that'll save you money. Septic tanks, that's another one. If you have, a lot of people don't realize when you look at these big homes, they're not on sewer. Because if you see that big home and it looks like it's a half a mile from the street, it's on the septic. The city's not gonna run sewer half a mile, you know, to their house. So it's on septic. So you wanna make sure they've had their septic tank service. You wanna make sure the house wasn't originally a 3-bedroom house, 2-bath house, and then they converted to a 6-bedroom, 4-bath house, because that septic tank ain't built for that, and that's gonna blow up one day, and that's not good. So there's things you wanna look at that your agent can help you negotiate, closing costs, and also future costs that you may have to come up with, home warranties and things like that. So your loan options are conventional. Conventional, you used to have like a 660 score. Now there's no minimum credit score on conventional. So if you can get your loan approved and it's through a Fannie Mae or Freddie Mac system, then there's no minimum credit score. But I'm still saying you usually have to have a 620 unless you're putting down 20%, because you do have mortgage insurance, like monthly mortgage insurance. So on FHA, you can get approved on an FHA loan, believe it or not, with no credit score. You can have no credit score at all and get an FHA loan. So you'd have to have alternative credit, which is such as like, I got car insurance, I got rent, you know, I got my rent, you're gonna have to definitely have rental history, or even stuff like we were saying, Klarna and stuff earlier, you don't wanna do that, but like you got a phone bill, life insurance and stuff like that. Georgia Dream will do you with no, will give you a loan with no credit score. VA will do loans with no credit score also. So minimum credit score usually for FHA, if you're gonna put down 10%, is a 550. If you wanna put down 3.5%, it's a 580. They do have some DPA programs starting at 580, but most start at 600 or 620. FHA, but we're gonna look at is really they want at least 3 trade lines and they want some rental history. Like you want it, so if you're living with somebody now, they're like, oh, I put something on the bills. I don't care if you only put $150 a month on the bills, write the check or zell it to them and call it rent. Because that's the biggest thing is people don't realize is that rent is the biggest determinant of how you're gonna pay your mortgage. So even if it's not that much, you wanna, if you're paying somebody to stay there, just call it rent. You might not even be rent, they just like, just call it rent. FHA also is more lenient. You don't have to have perfect credit score with FHA. FHA looks at really the last 12 months. They don't want any they don't want any late payments on installment accounts. So like if you go through, you don't get an automated approval, as long as you only have 1 30-day late, say like on a car note or a student loan or something like that, you can still get approved for FHA. Now if you got 6, it's probably not that. But if you have a high credit score, the system may approve you because a lot of people just happen to forget, like student loans came out of forbearance, how they kept going in and kept going out. So those are things that you want to look at. And like, so I might pull somebody's report and they're like, my student loan was in forbearance, but they took it out of forbearance. You know, it came out and you never set up a payment plan and they got 3 or 4 lates on a student loan. Sometimes you can get that out, or if you have enough income or you have enough assets, you can still get approved. VA is great. VA is the most lenient of all of them. These guys can have a collection, they can have all this other stuff and still get approved. They look more at like stuff in the last 6 months for VA. So if you know any veterans, and they can use these loans for multifamily. Same thing with FHA. You can buy now at FHA, you can buy a quad going FHA. So you can, if you're gonna live in one unit, you're gonna rent out the other 3, you can use the rent, the anticipated rent that you're gonna get that and still use FHA. VA, same thing, you can go to a duplex. Conventional would let you do it, but it's gonna give you less credit for income. USDA, not just the meat, but they also provide loans. So USDA out in rural areas, they give you funds. They have a certain amount of funds set up to where they give people, homeowners, money. So USDA, sometimes you can have no credit score, but usually you used to have at least a 620. It's 100% financing. VA is 100% financing. So if you're out in the rural area, and then you can usually go on the sites and see like, this house is kind of out here. I wonder if this qualifies for USDA financing. You can ask your agent or you can Google it yourself. It's like USDA eligible. It'll come up, it'll say, hey, what's the address? And it'll show you the little pins on the map. But believe it or not, like this could be approved USDA and then the house over there not, just right across the street. So it goes by that and it's updated all the time. It's a good program because you don't have upfront, the monthly MI is very low, where FHA probably has the highest monthly MI, but FHA takes most 60% of the buyers, to do close on FHA. USDA also does manufactured homes into this. All these you can also do manufactured homes. I don't know if y'all know, they got triple wides and stuff now, like 3,200 square foot manufactured homes. So we do those too. Jumbo loans are just that, like anything that's over 750,000 is going to be considered a jumbo loan. So with those, there is no 100% financing. You usually got to put down at least 5 to 10%. 5 to 10%. There's only a few lenders will let you put down 5%, and they're really just basically conventional loans that are large loans. VA does not have a jumbo, so a veteran can still go buy $1 million+ home and it not be considered a jumbo mortgage and not put down any money. So that's another benefit for veterans. Non-QM, where this is called non-qualifying mortgage. So anything that's not a 30-year fixed rate mortgage is really it's considered a non-qualifying mortgage. So non-QM is also, that's where you hear your stated income loans. We have an entertainer client, doesn't file his taxes, doesn't do whatever, gets loans, has a lot of money in the bank, so we just look at all the money he gets deposited, and it's called a bank statement loan, and they say, hey, based on this, he can afford this. Every time he buys a property, he puts down 20 to 25%. You have no doc loans, because you have some people who are like, hey, they got settlements, and they don't really have a job, because if you just won a few million, if you got won a few $1 million in a settlement, why are you gonna go work? And so they don't have income coming in, but they have a lot of money, so they do asset depletion loans. So like if you got $1 million in the bank and you're putting down 100,000, so I want to take $900,000, divide that by 60 months, and that's your income. So there's a lot of people like that, and you can also combine that. Like I've had couples where the wife was a nurse and the husband did something, did something else, so you can combine like a bank statement loan, with those other things like that. So there's a lot of loan options, and that's why you want to know what's the right loan for you. And the biggest thing is, be honest with me, and then I can tell the underwriter what they need to see. So it's like an agent, like Jerry Maguire, when he was like, let me know that your knee hurt, then we'll just have you not run a 40-yard dash or whatever. So it's just, you want to be honest with your loan officer, so we have all the tools needed to get you approved. Everybody gets paid on commission and everything. Everybody knows that. So, but we want to get you the tools, and we want less stress. You don't want to be out there wondering to the day that you close, am I going to close on this house? Did I get this done? We want to get all that stuff done up front. So this should be based on your goals. It's not just about your rate. Strategy does matter, because guess what? You could have a 4.99 and then it costs you, and you need 10% down, where you can have a 6.5 and you bring no money down. That's, what I'm saying, that's your decision. So it's like, and I tell people, you marry the home and you date the rate. You gotta have a plan to get into the home, and you have a plan to keep your home. So down payment is based on your pre-approval amount. So like if you have a $200,000 home and your 3.5% on FHA is gonna be $7,000. Depending on the loan, can vary from 3.5%, like we said, to 20% down. Where these funds come from, they come from your side job. Like we may not be able to use your side job to qualify you, but we can use your side job for that down payment assistance. For your down payment. So what I mean is, you work at the airport for the last 10 years, but you got a side job that you just started 6 months ago and you make $2,000 a month off of it. We can't use that to qualify you because you haven't been working both of those jobs for 2 years simultaneously, but you can use it. But some people do. So like we had a client, he 2 great jobs because he's IT and he could work, say he's working 40 hours on each job. He used both jobs to qualify and bought like $1 million, $1 million home. But he had to wait until he was on both jobs for at least, 2 years. And so like people, so they basically do that is like, they want to make sure you have a history of working a side job. They don't say, I'm just gonna get an extra job to go get this house, but that's not what you do normally. They want to make sure that's what you do normally. It's like with traveling nurses. Some of those things are harder because you got to go through, like if they're doing that, they average their income because they may work 6 months for this place, then work 3 months for another place and go there. So they don't ever want to work the same place for like 2 years. So on different things like that, we average their income for the last 2 years and their year-to-date income. Savings. Do you have money saved up? Like, do you have a savings account? Have you started a savings account? Do you have a 401k? Or your parent or family going to give you a gift? Now, this is a big thing. A lot of family wants, like, we'll give you $10,000 to buy a house. Problem is, grandma wants to give you $10,000 to buy a house. Grandma got to show me her bank statements. So grandma don't want you. I literally had a client. She won lotto, like not the big one, but she didn't want her kids, and she was like, I'm giving them each money, but she didn't want them to know how much money she had. So the condition was for them to get their grandma's bank statements. And then grandma called me. She's like, I ain't doing it. I'm giving the money, but y'all, I'm like, you can just send it directly to me because we got to make sure that grandma ain't a drug dealer, that grandma ain't just gonna. They got to source all this money. Isn't it true? Yeah. So we gotta source where your funds come from. So you can't just go. I had a guy. He actually went to go get a loan for his down payment. I'm like, dude, you can't go get a loan. And he was getting 100% finance. He went to go get a loan for his closing costs. So when you go get a loan or open up any new account, that goes against your debt to income ratio. So that's why they want to source the down payment. So a lot of times if you're looking and people come like, 6 months and they're like, okay, I'll need this amount or whatever, that's what you got to know. Like even if you get 100% financing, then it's up to your realtor to say how much they can negotiate closing costs.
So, just to make sure I'm understanding what you're saying, as far as the side job. You're saying you can't necessarily use it as qualifying income because you haven't been on it for at least 2 years, correct?
Yes.
But I guess in this instance, the only time it would help the buyer out is as far as just down payment. And that
Yes.
Okay.
Yep. You can use that money for down payment. You could go sell a boat. Like I've had people go sell a boat. I fix cars. I sold a car. You just have to have a bill of sale for it. They just won't use it for qualifying income and stuff like that. So
say that again. You gotta have a what?
A bill of sale. A bill of sale. Not
the guy with the motorcycle?
Yeah, not a Zelle for a motorcycle. Not a Zelle or Cash App for a motorcycle. And then we have people who, like, somebody did party planning.
Yes.
And then she's like, I do this, and it was her side thing, and she didn't really whatever. But I'm like, I need an invoice, I need something showing, it came from these people or whatever. So we don't care about how you get the money, then you gotta do it. But if it's reserves, that has to be your own money. Like, so if they say, hey, we can approve you, but we need to see that you have at least 2 to 3 months of the mortgage payment. So say it's $2,000 a month, meaning you see you still have $6,000 after all your stuff at closing. Then you have to have that money saved up. Your grandma or anybody can do whatever, and they can give you all the money for closing costs, but they can't give you your reserves. Also, if you're a husband and wife, sometimes one person doesn't have good credit, but y'all have a joint account, then that's not considered, that's not considered a gift because that's your spouse. Or if y'all have an account and you may have somebody you're not married to, but y'all share an account, they would just have to write a letter saying you have any and all access, to the funds, in those accounts. So those are things that you want to look at. But gifts are good. People put their kids on loans. The kid got to be 18. Yes.
So I haven't heard you say anything about no down payment cost. So like, say for instance, I want to do the DREAM program as an educator. What would be the expectations if you don't want to put nothing down? Or is that smart?
No, it is smart. It's very smart. I mean, if I went to go buy a new car today and it was like, put down $10,000 and your note will be $150 more, don't put down nothing, I'm going out of there with nothing. You know what I'm saying? So I'm always going to do that. But So the Georgia Dream, it's gonna cover 100% of your, depending on the loan, depending on the purchase price. Georgia Dream is maxed at 12.5. Okay, so like if you buy a $200,000 home or right over like 225, it'll pay all your down payment, but you still have closing costs. So you would still just say on that $200,000 home, you'd have at least probably another $10,000 between prepaids and closing costs. That's where it would be with your realtor to negotiate the seller, you know, helping you to pay some of those closing costs. So the seller said, so you got 100% financing on the house, 200,000, that's done. You just don't have your closing costs. And then you tell, hey, Charlette and Monica, I only have $4,000 to work with. Then they're like, okay, we know it's 10 grand, so they're gonna negotiate the seller paying 10,000, you know, at least 6,000 of your closing costs.
So you still are expected to have somewhat of
Yes.
Okay,
Yes.
and one last question, I'm sorry.
Yes.
So, like you said with the 2-job thing, being on a job for more than 2 years.
Mhm.
So say, and I'm just gonna use myself for instance, I work in education, but I also have a part-time job at Bath and Body Works.
Mhm.
But I haven't been, I'm still employed there, but I haven't, and I've been there over 2 years, I just haven't worked in some months.
If you're still on the payroll.
I'm still on the payroll, so that counts. Oh,
Yes,
okay.
that I just did somebody, she had 4, she was a traveling, whatever, radiology tech, and she was signed up with 4 different companies. And she never resigned from them, she would just only work a few hours a month, or sometimes she didn't work that month. We could count all 4 of those incomes because she was signed up, and she never resigned from all those. And she had a W-2 even just a little bit, and that was like $300 a month helped her.
That's me.
So just get go pop up on Black Friday or something. And work on some hours. And it's just like that. So it's like I wouldn't quit a job that I have if I'm looking for a home, because you don't know how long it is. You may be there a year and 8 months, you're like, I can't count this anyway. Then it takes you 4 months to buy a house. Then you're gonna be at 2 months. 2 years. Same thing with credit accounts and stuff like that. Don't close anything unless we tell you. A lot of people are like, I'm gonna go pay off everything on my credit, then I'm gonna come to you. My scores drop because if you don't have, your credit scores are built on equity that you have online. So if you have a $2,000 credit card, yes, and it's charged up to $1,900, your credit score is gonna be lower because you're maxing it out. But it's gonna be worse if you close it, you don't have any equity. You can't have any equity online, it doesn't close. So another thing that we do is like when I pull a report, I pull what's called a credit expert report. So it's just all AI analytics. So people don't realize when you get approved with a mortgage, it's your trending report. So if you have like 4 credit cards and you hardly ever use them, and then over the last 3 or 4 months, your credit score may not still be bad, but your debt increases, you may not get approved for a loan, certain loans because it sees that you're trending to be more debt heavy. You see what I'm saying? So then it goes, but also, so then I can look at the report and say, hey, you may think I gotta pay all these off, and I'm like, go pay this card down $300 and go pay this card down $50 and your score is going to jump 40 points. So that's what I do. That's the things that you should do. Like a lot of companies don't do that. It costs me an extra $5. I'd rather send you that report so you know what to work on instead of guessing. It's like me, do I have COVID? Do I have sick? And it's just allergies. You know what I'm saying? I didn't or on Google and gave myself cancer and it was just something else.
I'm sorry, I got on.
No, you're good. That's what
So
we're for.
I had went through like a pre-approval process and I was at a standstill, and I'm gonna use myself as an example. So like 3 years ago, I had a credit card, right?
Mhm.
And it maxed out and I just stopped paying on it. So they closed the account. And so the guy was telling me, really you need to pay this off because it's affecting your credit score and it's showing us like you're late on these payments, and basically you would need to pay this down, give yourself roughly a year so your credit score would, I guess, recycle back. And so that's what I'm in the process of doing now. Like I have this one credit card that I'm paying off, the account is closed, because they closed the account because I stopped paying on the card. So I'm in the process of paying that balance down, and I just wanna know, like, should I just continue to just focus on that, or can I still start to?
That's where I would look at your report and run that credit expert report, because sometimes, depending on how old the debt is, like, if it's older than 2 years old, I just let it sit there. Because what happens is, if it's not open and you can't use it, like, if it's a charge-off, then yeah, it's effective, you can settle it and pay it down. Like, and I tell people, don't pay off stuff, like don't pay off collections unless you agree to give me a letter saying you're gonna remove it from my report. You get what I'm saying? So like, just paying a collection down to 0 actually can drop your credit score. So like cause it just updates the last day of activity. It doesn't look at whatever, it just shows there was a collection activity on your report last month. You see what I'm saying? So that you
So
want
it's not
to
in
do
collection, I'm just paying it off.
Yeah.
The account is closed.
but it's still active.
It's still active.
So you wanna
because I'm
keep
on a
paying that.
payment plan, but I'm paying like chunks of it.
Yeah.
Yeah.
So you wanna pay that,
Mhm.
but you also will probably just wanna go open up like a secured credit card for new credit, because that credit doesn't have any equity on it. You
I
see what I'm
have
saying?
other credit
Yeah.
cards that I'm.
So you just wanna keep those down. Like I tell everybody, like, if you have 5 credit cards, then you need to put something on all 5 of those credit cards a month. Whether you put Netflix on one, Hulu, your gas bill, and just don't pay them down to 0. If you pay them down to like $10. Because you wanna leave a balance on it, you wanna show activity, because all your credit report is reputation. Only if you haven't done anything, they don't know what kind of payer you are. So and everybody's different. Some people got 1 trade line and somehow got a 720 score. I don't know. You know what I'm saying? And then some people don't. They got 4 and they.
So if you're using a credit card and you're saying are you recommending not to pay it off? Like,
Not to 0.
not to 0 it, but maybe down to like $10 just
Yes.
to keep something open, something
Yes.
reported to it?
Because the day that I pull your credit report, it may say nothing's open. You get what I'm saying?
Okay.
So like, it depends on the day that someone pulls your credit report. If it shows a 0 balance, like if you have, like literally I'll do that credit extra report and it'll tell people put $10 on this card, put $12 on this card, you know, whatever.
That's how they grade you.
Because that's how they rate you, because it's not showing, it's technically not an open trade line, like it'll go inactive, like some people, they'll go, like, well, credit cards are usually initiated for people use them for big stuff, get a new transmission, go on family vacation, so now we use credit cards, you know, more often. So like a lot of people's balances are higher, but you don't wanna ever not have anything, you know, on that card, just like $10 or something like, $10 or something like that on there, so you do wanna leave some balance on it, yes.
That's not it.
Yeah, so you wanna leave a balance on the credit card. And then everybody's a little different, like some people, like you may wanna take off, like, well, I only pay off a card, pay off the smallest card, like pay that one off first, instead of knocking out that big one. You probably could pay out 2 little credit cards versus trying to knock out that big one first.
Like, for example, my mother has like over, I don't know, she probably like an 850. Well, she had paid everything down to 0 and she got an alert, my credit score dropped. And so Reggie was telling her is because my mom pays everything down to 0. So Reggie was explaining to her that it dropped because she's not showing any usage. It dropped like 60.
And the other thing that they do, if you don't use the credit card, they'll drop your
Your
credit limit.
So if you,
And that drops your score.
Yeah.
let's just say you have like 3 credit cards, should you put like maybe like gas or something
Yes.
on each of them? But if, okay, so like I have like, I don't know, 3 cards,
Mhm.
but I use 1.
Mhm.
So is that okay to like show that activity, or should you be showing?
You need to use all 3 of them.
them.
Even if you just go get $10 worth of gas or
Okay.
buy, you know, I try to tell people not to use like credit cards for like food, you know, food and stuff that's going, but just like if you put $10 worth of gas or do something, put your Hulu bill on there or something like that, just so it has some activity every month.
Okay.
It could be something very small, but you just want to have activity. Then you also sometimes want to get something bigger, because they will, if you got a $1,000 trade line and then you're only using $200, they'll drop you down to $500, and that will actually decrease your score. And another trick is, if you have a credit card and you've been using it, just apply, it's not a new application, just say, I want a credit limit increase.
Yeah.
So it does the same thing as if you paid it off, but you just like, oh, I had a $500 limit, and they gave me a $750 limit. It's like you paid $250 on there, and that gives you a score boost too. So that's what I kind of look at people's stuff, and this different stuff. It's like the old school thing, I'm like, I'm gonna pay off everything, and then I'm gonna go buy a house. It doesn't actually work. Like in the old days, that's what it worked when I first got into business. I would just tell people pay off all their collections, and then, you know, then we'll get you a loan. Because you didn't really go on scores. It was just like, they look at your collections and all this. Now everything is score based and all that stuff, so.
And I do want to make another point too, when she asked about Georgia Dream. I think it's really important. Georgia Dream is a great program, but I think what a lot of people don't know about Georgia Dream is they charge so many points up front.
Yeah.
Which, if Georgia Dream works, if you have a seller that's willing to pay a good amount, of closing
And
costs.
so what she's saying is, so what field are you in?
School social work.
So you get 12.5. So you're on the PEN program, protectors, educators, and nurses. Georgia Dream is gonna max you out. They're gonna give you $12,500. If you got a $200,000 loan, Georgia Dream is charging you $4,000 to give you $12,500.
So that wouldn't be the best.
If you got the closing costs.
If you got the closing costs, yeah.
But your agent, you know, Monica would know with Georgia Dream, she would know that she would need to get you a lot of closing costs.
So like, yeah, so like, and it's,
It'll work.
but like, and so what I would do is I would send you, here's the Georgia Dream numbers, here's our Cardinal Elite numbers, here's Chinoa. So like our program is our own DPA program. You don't even have to be a first time home buyer. You just have to have a 600 credit score, and then your credit score depends on how high, you'll be able to go. But it gives you 3.5% or 5%. So Georgia Dream, they're maxed out at 5% or 12.5. That doesn't matter if you're buying a $500,000 home or a $50,000 home. So like even somebody on the lower end, like if they were at $100,000, they wouldn't, if they were like an $80,000 house somehow, like in some of these rural areas they can't even get the full 10,000 or 12, or 12.5. But it depends on how you work it. Like I have people go USDA or veterans, they don't need a down payment. I would still take them through Georgia Dream because they can get their closing costs. You see what I'm saying? They get 10 or 12.5 in closing costs. Our program, like if you go in, if you buy a $300,000 home, that's not going to help you that much. But like ours, our par rate is going to go all the way up to the percentage that you need. So you need 3.5%. We got that. We actually do 5%, so that'll actually help buy down, your rate on the first. So I always go through with you. Like I'm on the advisory board for Georgia Dream, so I like Georgia Dream. But I also know that the fees, are a lot. If you get an agent or seller who's like, I ain't paying nothing, you know what I'm saying? You better have your own stuff. But Georgia Dream is going to give you a good rate. It's going to give you that below market rate. So everybody, whether they have a 640 or 840, are treated the same on Georgia Dream. Whereas on other loans, like the higher your credit score, the lower, lower your payment's going to be. So it's a place for it and it's good. And they even have Georgia Dream Plus now, like people are making more money, so the rate is a little higher. But sometimes people are using it just, they may have their down payment and they may just use that money for their closing costs. And then you don't have to pay that money until you actually sell the home or refinance the home. Whereas on like our DPA, it's paid over 10 years, but it's only like, so if you got a $200,000 home and maybe $140,000 payment, $140 payment, for 10 years for the second lien. But it's again, like we had a client, do you have the $1,350 or do you want to pay the $140 a month? So documents needed are ID, government, so then use your passport. We prefer to use your driver's license. Your passport, military ID, something that's government issued. Income docs, your W-2s, not the ones that your tax return preparer gives you, but the actual W-2s from your job. And if you worked 6 jobs in the last 2 years, I need all 6 W-2s. 1090, if you work W-2 and 1099s, we need the 1099 even if you're going just W-2 income. Bank statements. You gotta have your bank statements. You gotta have full bank statements, at least 2 months worth of bank statements, the most recent 2 months, and it has to be all pages. So like, if you see, oh, that last page is blank, but if it says pages 1 to 6 and you only sent me 5, underwriter's not gonna take it. You can't redact your bank statements. So you can't like, I want them to know that you went to the package store 3 times. You know what I'm saying? Last year. You can't redact or scratch out anything on your bank statements. I mean, we do learn a lot about bank statements. The underwriter will go through your bank statements. They're going through there for stuff. Speaking of bank statements, the Affirm, the Klarna, and all that stuff. If you have all those things and you're using those before you close, you have to pay those off. So, because what happens is they don't know. They don't do it all. They start on the day you pay them, so it's not like they're doing the 1st or the 15th. You might have opened up one on the 6th, and then you pay a payment every 2 weeks after the 6th. So those things, and they also let people don't put a car. There may not be a car on your credit report, but you went to a buy here, pay here, but it shows up on your bank statement. So the underwriter's like, what's this $380 a month debt that he showed the last two months? And I'm like, what? And I'm like, hey, Mr. Smith, what is it? Oh, yes, my car. You can tell me you had a car. You know what I'm saying? So you had to buy here, pay your car. I won't know because it wasn't on the report. You see what I'm saying? Or child support. They not put it on the thing, but we see something coming out from the state, out of your check, or off your, out of your bank statement, or a tax lien coming out of your account. So that's why they want to get the bank statements. And they want these 2 months, because they'll see a pattern out of the 2 months. Assets, bank statements, you can have CDs, money market accounts, whatever. People don't treat like paid off, like I had somebody write that they had a paid off Chevy, whatever. That is not an asset on loans anymore. It used to be back in the day. Unless you're gonna sell it and you can't get the money for it, that's not an asset. I've had people jet ski. I'm like, why is this on here? It's not. Then you have contracts. Like one thing you do have to watch out: if you buy a home and it has solar panels, did those people pay for the solar panels all at once, or are they leased? If they're leased, it's a problem. Like we do it, but we make it. We have a program where they're paid for in a loan. So those are things. Or any, what's the tower? Oh, the cell phone tower.
Yeah.
If you have a cell phone tower on your land, that could be a problem. So if you got this big of land, like, oh, cell phone tower, and it's not on your land, but it's right over your land, and it could fall and hit your house, then we have to get something from the county, and all that stuff. So
about bank statements, I think it's really important because I know I had a situation where a buyer showed her Bank of America, but she also had a Wells Fargo.
Oh,
and so it was transferring money. So she was like, well, I only have to show Bank of America. And they came back to kind of explain that to
so
them too.
if you have any transfers going into if you have any deposits going into your account that from another account that aren't just your job, then they will say, oh, this money was transferred in here. So you're like, okay, I needed to pay, my money for my down payment. I transferred it from my Wells Fargo to my Truist account. They gotta see that Wells Fargo account. And they gotta see 2 months of that Wells Fargo account. Then if they're looking at Wells Fargo account and it's just you on there, and they see that buy here, pay here card, or they see this other stuff, Affirm and all these things, then that could cause an issue. So any banks, like a lot of people intermingle, they'll have to just go into one account and they transfer money, to that account. That's why I always, when you'll see my email, it's like, can you send me any and all accounts you have the last 2 months? So that way we can see it up front and do whatever. And then you looking for a house, you have time to change it. I'm like, okay, we don't want to see this account. You got too much stuff going on in there. So just stop transferring into that account while you're looking for a house, because all I need is 2 months bank statements. But that's why it's important to get the stuff up front, or whatever. Appraisal is the value assessment. We want to make sure we're not loaning more than this home is worth. The inspection is for you. The inspection tells you like, oh, that you might need a garbage disposal, or, we saw some beetles or something by there, you want to get checked out, or your water heater will probably have to be replaced in a few years. That's what the inspection is. The appraisal looks at like, is the water heater working? Does the AC work? Is the roof got stuff on it? Do I see water leaks? Is the value foundation? If they see other foundational stuff, like if you see the cracks in the wall, they may ask for a structural inspection. If they see the crawl space, if it's not, what is it called? If it's not wet, whatever it is. A lot of older homes, people just got the dirt down there. You can't do that. You're supposed to have the plastic,
the water
barrier under your space. So you got armadillos and all kinds of stuff under there. They want all that cleaned up. So the appraiser goes through all that. They'll go up in the attic. Usually they'll just get on the ladder and look up there to make sure you got insulation, to make sure nothing's messed up. So the appraisal and then your debt to income ratio, this right here in your credit score determines what you can afford. So what most people don't realize, like, I make good money, and I say, but you have great debt. So your great debt is overcoming your good money. So it's like, I make good money. I make $100,000 a year, but you got a $1,400 car note on this Escalade, whatever, thing, and then you got this, and you got that. And you got 2 of them, you know what I'm saying? Then you got another $800 car note. So basically when you look at on a mortgage, they don't ever want, no matter how high your credit score is, for your home expenses, that's your PITI and the HOA, to be more than 40% of your income. So you could already know, like, if you make $5,000 a month gross, your mortgage can't not be more than basically about $2,200 a month. So that lets you know kind of up there, just, what you can afford. Because if somebody, they call me, and, I'll tell them, hey, I still need you to do the app online, but I get some stuff, and they're like, yeah, we're looking at a $500,000 house, and, what do y'all make? Well, together we make about $8,000 a month. That ain't gonna happen. Because I said, you have a car note, do you have whatever, but when you look at it, but they may have other assets. They may have child support and stuff like that. So, and a lot of times, loan officers, we're gonna get in your business. If I see you fill out an app, and I see you got 3 kids, I'm gonna be like, do you get child support? You know what I'm saying? Because not that you're gonna use it for that, but it helps you qualify. You know what I'm saying? And even if the dude doesn't pay it, or somebody doesn't pay it, if it's supposed to be $800 a month, and he only been paying on average of $500, I can use the $500. makes or break a loan. Somebody got $150 a month from their dad dying from the railroad, and that was all these did. And she was like, oh, and I get this little pension thing. I'm like, okay, that helps, because I was gonna tell you to pay off this payday loan. You know, you gotta pay that, pay that stuff off. So all that stuff matters in your debt to income ratio. Student loans, I don't know why you forgot to put that on there. Student loans, just because they're deferred, they kill your loan. The two things that are kryptonite to a mortgage loan are student loans and child support. Student loans go through, because you cannot say, well, oh, I pay it, or whatever. The dude could be like, oh, the kid's about to turn 18. Until that kid is 18 and that child support's working, and the kid's like he graduates in May. And when he graduates, he turn 18, then we cannot count it. It could be like you only have 6 payments left. Student loans, because you have zero. So if you have $100,000 worth of student loans, but you have them all deferred or forbearance, we have to count $500 a month against your debt to income ratio. So it's easier for you to actually have a true income-based payment plan and get a payment. So even if they say, okay, you're like, I can't pay that much, but I want to at least pay $10 or $25, then it's better for you to pay $25 a month, even though they ain't doing nothing to the $100,000 student loans, than to have us count $500 a month. Yes.
So to your point about student loans, because I usually try to reapply for an income-driven repayment plan, and it says in line where deferred for forbearance project for up to 12 months. Should I still, even though I'm not, I guess, being penalized for not sending a payment due to the fact that we did, and then you're saying still send something in?
Yes, you need to set up something to say, I want to pay at least, just call them and say, like, next time, like, I want to pay at least $10 a month or $25 a month. So, like, because that way we just use the payment that's on the credit report. If not, they use 0.5% or up to 1% on conventional loans. Yes.
And so how long would you need to do that? Cause I had the same thing, I had student loans and then forbearance and all that.
After you close, you can go back to paying zero.
Okay, so I need to at least show paying $10 for 3 months?
Yeah, you need to get it, you need to have an agreement though. So you need to go through it and say, hey, I want to pay something. I appreciate you, this is what I tell people. I appreciate you saying I don't have to pay anything, but I want to pay something. So like, and they're like, so on this, all these, can I pay at least $10 a month or $25 a month on these $100,000 of student loans? Then that's all I have to count against your DTI. If not, we're counting 0.5% of the outstanding balance. You have some people making $40,000 a year and they got $140,000 of student loans. They won't be able to, purchase ever unless they get like a spouse or they go get a whole second job, to pay those student loans or something like that.
And so you would need to at least see that you're paying on the $10 a month for at least a 3-month span, or just?
No, as long as I have an agreement.
Okay,
So
so that's
you-
something written from the loan
from the
company
loan
that you're
company,
paying?
yeah.
Okay.
That you set up, it's gonna say, so if you have 8 student loans on there, it's gonna list all those student loans by the number. It's gonna say for these $100,000 for student loans, her monthly payment is $25 a month. So you actually have to have an agreement. It's not just you sending in, a little bit. You actually have to have an agreement.
So it's not the amount, it's not the length of time that you're paying on it, it's the agreement that you see.
Yep.
Okay, cause she said something that, made me think. So let's just say, next year around this time, that we're looking to buy, and I was to call them, I guess, let's just say 4 months out, say, hey, I want to set something up. Could I do that, or does it need to be like a year?
Nope, you can just do it then.
Okay, cool.
You can do it today. Like if you try to buy 2 months from now, you can do it today. As long as you get it done. Yeah. You just get it done. Don't accept zero. Yeah, because they're getting off the phone, y'all. They figure nobody wants to pay, and that's the easiest thing for them to do. They just gonna push it off. They're like, oh, you don't have to pay nothing. And they gonna get off the phone. They think they did their job, but they're hurting you, by doing that. So that's, and people are like, well, it's the only people that can have that situation are veterans. So if a veteran, if their student loans if they're not doing repayment for at least a year past their close date, then they don't have to do that. But everybody else has to have an actual plan set up where they're gonna use that formula of 0.5% of the outstanding student loan. So like, even a lot of people, they're like, oh, I got all these, they go to this technical school or something, they got 10,000 on and 15,000 and there'll be like 20 on there. And they don't think how much it is. So automatically when you pull in the application, it puts the 0.5% in there, and they're like, oh, I said, you got like $400 worth of monthly student loan payments. They're like, no, I don't. My student loans are deferred. So I gotta go through this whole, thing with them, explaining it to them or whatever, but it hurts you to not be paying anything if you're trying to buy a house. So, but yeah, that's a big thing. Student loans will get you, and you gotta watch out too, like when they pop out of forbearance, you need to put on your calendar like a month before, or like, hey, I need to go, set it up and make sure it is, because those count as 30-day late installment payments. So it counts as much as you missing your car note. So, time frame for closing, this depends on what type of loan you're doing. So if you're doing a straight up conventional loan, you got down payment and it's simple, then you could close in 21 to 30 days. Most of the loans close within 21 to 30 days. I had a lady, she had her own money, she had everything, she was buying a condo. The HOA sucked over there, they had the wrong insurance, it took us 3 weeks to work on that. You know what I'm saying? So it depends on, it's not just based on you, it's also based on the seller. Or, the appraiser might come back and say, hey, they need to get this deck fixed, or these rails installed and stuff like that. And then the person's like, well, we gotta get the money to do it. You know what I'm saying? And so then you might have to wait to get that done or whatever. USDA loans and Georgia Dream, USDA, I say 45 days. USDA is gonna take 45 days. Georgia Dream, I can still get those closed in 30 days if you got all your stuff up front underwritten. If we already have a loan approval on you, because you can't send a loan to Georgia Dream or USDA or Atlanta Housing or anything like that until the loan is basically totally approved by the bank except for the down payment assistance. So those loans, that's where you do want to know your agent to negotiate it, because it's an art to doing that. Like you may like, oh, I know this seller don't want 45 days, but we're gonna ask for 36 days, then we're gonna use our 8-day unilateral or whatever,
So when it comes to that, wouldn't it make sense, like, couldn't you make sure your plans are like underwritten ahead of time, like can't you do to be determined?
Yes, most of the time if you do a loan with me and I feel like you can get approved right now, I would do a TBD underwrite. So that basically they've underwritten your credit and your income, so all we need is a property. So that's the best way, and that's the best way for you to go shop. It's like you going out to the car dealership with a check already. So that's the same thing. It's like, oh, my person somebody else sends over a pre-qual letter, you actually have underwritten, approved, pre-approval letter. They know that your file has been looked at. So, again, it's like she's saying, faster with preparation. It's a pain to get all the documents, and then I'm probably gonna say, this ain't what I'm looking for, or get your finger out the picture. You know what I'm saying, or whatever. But you rather have it up front. We do. I've got pictures with chicken stains on stuff, people's fingernails all on the ID, like put it on the thing. And then all it is really everything has to be in a PDF format. So like you can actually, like if I say that you can use my phone, like you have to use the scan mode on your phone, not taking pictures of the front, of this.
Not a JPEG.
And don't send it to my phone, send it to my email. But our system lets you upload it. Most bank system will let you upload the documents. The thing I do, I still like people to upload them, but I still go look at them. Because you can upload something that kills your file.
Yes.
Like if you're not needing tax returns, and if you just filed your taxes, and they see this large deposit come in there, like, how she make $45,000 a year and got back $16,000? I don't know. So then, the underwriter, she just closed yesterday, she thought she messed up her loan, she gave me tax returns. She was trying to go Georgia Dream, gave me tax returns that said she didn't file any business. So she just took the Schedule C out, or gave me tax returns that didn't. When we saw the deposit, the underwriter says, oh, we need your 2025 tax returns. So then I'm like, you wrote off $22,000 your income? And she was like, she didn't have nothing to say, she wouldn't pick up the phone. I said, we're gonna switch it to our DPA program that doesn't allow it. Underwriters can't unsee stuff. So there's ways for us to do it. So she got closed and she was crying and all that stuff, we got closed. But if you have questions about stuff, I'd rather you call me first and just email that to me. And then I would be like, hey, this could be a problem, or you can use this, or you can't, use that, things like that. So you do want to look at that, because the processors or transaction coordinators, they're just going to ask you for the document, and then they're going to tell you there's a problem later. But sometimes you can upload some of that stuff, like the closer you get to closing, like if they just need to see you have proof of funds to close, you can't just go drop 10 G's in there. They're going to be like, I hope there's no large deposits, or I hope there's no transfers, because then they're going to have to ask for that other stuff. So those are things that you want to be aware of.
So, I once heard that when you are in the process of buying a house with the underwriting process, they say don't have too much activity out of the norm.
Yep.
About what time frame? Is it like 6 months, 12 months, or is it 2
No,
months?
more just while you're in the process.
Okay.
So after you get pre-approved, don't be doing nothing crazy. Don't be transferring funds. Don't be doing whatever. Like, don't get a whole bunch of Zelle accounts, like all that. Cause like I tell people, you can go online and open up another account, on your phone. And just like if you got some side hustle, have that side hustle money go into that other account. Don't have it go into your main account or whatever. Things like that. That's what you don't want to do because that'll, bring up questions about, it'll just be a whole bunch of stuff. And some people don't. Like, you may go, like, work on somebody's house and I do painting and stuff for people on the side or party planning and they Zelle you $1,000 for their kid's 16th birthday party. And now you gotta, and that's, if it's more than 20% of your income, you know what I'm saying? Then they gotta look at it. Georgia Dream wants anything to source any deposit that's more than $150. And that can be easy. So you wanna look at some of those things. So yeah, you don't wanna have those, and you may have 6 accounts and we may not need all 6 of them. So we'll take them out or the processor will take them out. We'll see the ones, that we need and stuff like that. When you bring your funds to closing, you want to make sure a lot of people have these internet banks. They're going to ask you to wire the money. So if you got a bank and you can't set up a wire, or you got to go to, what is it? Chime. You can't wire money out of Chime. You got to go through this whole process to do Chime to wire funds. Some of these people you got to go into the bank. So you got to have a bank that you can go into, or that will be able to wire the money. And a lot of times, you won't get your final CD, your closing disclosure, until like 48 hours, 72 hours before closing. So you want to make sure you have time to do that. Like some people have, like one person he had a bank just that was only in San Antonio, it wasn't Navy Federal, and it was some small bank or credit union from where he was, and then they couldn't do, they couldn't do anything. They don't take checks anymore unless it's a small amount, sometimes less than $2,500, but it's up to the attorney because the attorney is held hostage because they send all the money to the attorney's account. Then the attorney disperses to the seller, and if you have to pay somebody off or something like, or debts and things like that. And when you get your keys, so this is what people don't realize, you get your keys, so like once you sign the paperwork that day, you're done. Like there's no rescission period. It's yours. Like if you do a refinance or something, you got a 3-day rescission period, so people get confused. So like if you start to get cash out your house, and you closed on Monday, you couldn't get that money until Thursday. You gotta have 3 business days. But when it's fun and everybody signed and that attorney gets up and closes that folder, it's done. It's a wrap. Yeah, so that was the other thing. And the other things that you want to do is after that, usually you want to make sure you know how to make that first payment. Usually banks will have it in there. They'll have this stuff in the folder so you can make it, but we email people 2 days afterwards. So they'll have it in their email on how to make that payment. A lot of times people set it up as a direct deposit, direct debit, or not, or you can just always go online and make the payment. And the thing about mortgages, people don't realize they're due on the 1st, they're late, you can get charged, they're considered late where you can charge a fee on the 15th, but they can't count you late on your credit report until you're 31 days late, okay? So if something happens, you do have that, you can't think about it. What if you're 15 days late on your rent? They're trying to keep you out. Seriously, you have more flexibility. They're trying to keep you out. And they charge you this. Then you're going to get charged service. Mortgage company going to charge you a late fee. And now the only thing that can happen if you're just constantly late for like 3 years or something like that, all the late fees, if they equal up to your mortgage payment, so you say you've been in there 5 years, then your mortgage payment is $1,500, and so the late fee now equals to $1,501, that can count as a late payment on your credit report. But you have more flexibility with that, with the mortgages and stuff like that. And then refinancing, like depending on, that's where the agents kind of come in. I always set people up on Homebuyer and stuff like that so you can check your values. Because you might have gotten a home and you say, you know what, I really wanted that Georgia Dream rate, but I took this other program and the rate is higher. Now I'm looking at the rates. And then you say, Monica says, girl, your house got like $30,000 worth of equity. And she's like, you think I can get my rate down? I don't want no cash out. And then that's where we, say, hey, have Monica check your value. This is what I see it as, but I'm not an agent. And then we can do a refinance, and then I would just send you estimates, about how to refinance and get your payment down. What you want, and then like when people look at when they refinance a home, it's just like, how much is it gonna really help? Like you still have closing costs when you refinance a home. If it's gonna drop your payment like $150 a month, and your loan amount, because they build it into your loan, and your loan amount goes up, you know, maybe $8,000, but your payment is still down $150 a month, that may be worth it. You get what I'm saying? So those are the things that you wanna look at. But, and I think you got all this stuff in here. Like, and I got stuff in you guys' file, but again, Georgia Dream, we do Georgia Dream. Any DPA program, that you guys are interested in, you look at it. And the thing about it is you don't have to be a first-time home buyer for ours. So like if you, it goes up to the FHA limit, and I think the FHA limit in Atlanta is $590,000 or something. So you could get 100% financing on 500 something, on almost a $600,000 home. So there's programs out there. You don't have to have perfect credit. You don't have to have all these people like, I want to wait till I get to a 700. They were saying something earlier. If you're waiting for the market to crash, it's not gonna crash. Banks learned during that thing. Banks are now like, they will foreclose on somebody and take that house, fix that house up and resell it themselves so they get the full price. There's not a whole bunch of like HUD homes and things out there. The other things too, you wanna make sure, like I said, banks, like if you don't, that's why they're making people escrow. People used to not escrow a lot of times and not have insurance on the home. Then the banks put bailment insurance on there and it ain't the cheapest insurance. And you pay that stuff, so you just wanna make sure you get it. But the thing about it is like, it's your home, like you may not be able to afford what you want now. I have this conversation probably 10 times a week, but we have clients buying houses that haven't even been in the house 2 years. Now they got $50,000 worth of equity. They got money to put down on the new house, or they go get another DPA program and they pay off $50,000 worth of debt. So, cause I mean, it's like how many people gonna save up, you know, just say she's been in the house 2 years. She wouldn't have saved up $50,000. We've been in our house 10.5 years. We got 300, I wouldn't have saved up $300,000. You know what I'm saying? But the equity just paying, because I have to have a place to live, because I'm paying that mortgage, you build the equity. So, and even with these things right here, these houses, this is the beginning of this community. So if he sells you a house at 340, the last house is gonna sell at probably what, close to 400,000? You ain't done nothing but pay your mortgage. And it's that same house, I promise you, that's how I work with home builders. It's gonna end up being $40,000, $50,000 more because they're building 80-something houses, so it's gonna take them probably 2 years to do that. And you haven't done anything but just pay your mortgage. So that's what you wanna look at, and a lot of people don't know, I mean, everybody, the wealth gap, that's what the wealth gap is. Only 36% of black people own a home. With Asian people, it's 60-some%. White people is like close to 70%. Indian people is like 70-some%. Hispanic people are a little more than us, but that's where the wealth gap is. Because you go in and you have this equity, and so that most of the people, 40% of their retirement is based on their home equity. So that's where people look at it's like I have a place to live, I don't have to go to an old folks home, or I have this, I can sell this house, and then I can go stay with my kids, and I can help them, or we can get a generational home together. That's where it is, because you never know. Gas is getting higher or whatever, and you're stabilizing your home cost right now. When you purchase a home, rent goes up about 4 to 6% every year. This year, because they couldn't push it up any higher, it kind of stabilized. But rent goes up. When you have your mortgage, unless your taxes go up or you get some claims on your insurance, it's going to stay the same. So that's what a lot of people don't realize. At least I know what I'm paying for my mortgage. You know what I'm saying? I'm not even trying to be funny. If I got a garage, I can pay my mortgage, put my car in the garage, and do whatever, and do everything bam, and just get it, so I get it together. So you have a place to, be, they got studies now, kids growing up in homes, do a lot better in school, their kids, stay in apartments and things like that. So it's a lot of reasons to be a homeowner, other than just saying, I just want to buy a home. I mean, it's going to help you, you have assets to, to go, like when you go someplace, they're like, do you own a home? You look like, do you own a home or you rent a home? Or you have this or whatever. And that equity is there. And God forbid something happens, you buy a house and you're single, you get married, you're like, hey, I got a house, we got rental property, or I can put down on this to do whatever. So it's good to have. You get your first house, then you start working on investment properties. You start, doing other things. But everybody has their own plan. That's what I try to tell people. So when I come to people, like his plan is not gonna be your plan and vice versa. Everybody has a different situation, everything. I may talk to him, he's like, you know what, I've been on that second job, I'm gonna wait 6 months. You know what I'm saying? Until I can count both of those, because it may be $100,000 difference, in homes for him. But our job is just to tell you, your options so you can make a decision. So. But my information's up there. If y'all got any questions, y'all can always call me, and thank y'all for coming out on Saturday. Y'all got anything?
Yeah, we do. Do y'all have any questions about financing? Because he's definitely your guy. if y'all have questions about Rory, I think he's gonna be here until the end.
Yeah, I'll be here.
And thank you for that,